All right, now let's take a moment to talk a little bit on the clarification of the Market Sentiment Tool. And this came from a couple comments that we've seen as the Market Sentiment Tool, September 29th, is entering very bullish buys. There was actually a third comment that just came in a moment ago from, I'm sorry, was it Ron? Yeah, from Ron as well. So we got a couple emails on this. Sorry about that, folks. We got a couple emails on this. The first one is from Maurizio, early September 28th. He says, could you explain to me why if the market sentiment is very bullish, the naked put selection doesn't show so much opportunity to trade? And from Mike G today, he says, I've been away for a while, and I'm scared to death right now of getting, well, not scared, scared to death about getting into the market. So today, when I finally access power options, welcome back, Mike. It's always good to hear from you. I noticed that the market sentiment indicator is at 10, very bullish buy. All I can say to this is, how can that be? I'll be listening on the webinar, hoping to hear an answer. First live question, of course, that came in was from Ron, and Ron said 929, market sentiment had a very bullish sentiment, surprising given the environment. All right, well, let's take a look at this and where we are. The bullet points from my response to Mike is the market sentiment is based on 13 indicators. Ernie found best showed a market reversal when they hit certain fences based on a historical histogram going back to about 2008 and beyond. When an indicator hits a certain point in a bearish decline, it historically rarely continues below that level, meaning a reversal from the current trend is likely. What does that mean? Is it just gibberish? What I mean is here is the distribution of the total percentage of stocks that are currently over their 20-day moving average. This was from the 29th. This was the close of yesterday. Only 11% of the optionable stocks, indexes, and ETFs are currently above their 20% moving average. Historically, this graph here represents every dot of every day of the closing prices of this percentage stock over the SMA 20. It's just one of the 13 indicators. I chose this one because it was mostly into the bullish fence area. What does it not look like it appears to ever do? Well, it does, but very rarely do you see it go into these levels down here, down to below 10%, to 5%, to 2%, only 2% of securities trading above their SMA 20. So historically, that means that this has to go back this way. Doesn't have to. My apologies, Mike. Historically, it does. Regardless of the situation, regardless of the current market conditions, that's generally what we see. And that's what this is showing. That's it. The expectation now is that this is going to revert back to where a higher number of stocks are trading above their 20-day moving average. And for order that to happen, the market has to move up. And then we see several of these go off in a row. 10 of the 13 indicators, as Ron mentioned, are now bullish indicators. That means historically, many of them are going to go back. Most of them are going to try to go back. Most of them historically do go back to a higher level. And in order to do that, the market has to start becoming bullish. The market sentiment tool does not take into account black swan events. News articles, recession fears, recession probabilities, what talking heads are saying is projected in the next 2 or 3 months. It's not really looking at bond yields in a way or inverted yield curves or things like that. But certain indicators that are there, such as the trend and everything else, will have a reflection on what the market is thinking at the time. The market sentiment indicator is essentially a contrarian output. What do I mean by that? I mean that when we see a bullish buy, everything that you're seeing in the market is doing the exact opposite. because it's supposed to be sort of a leading indicator that's telling you that historically, when these levels are hit, very infrequently they continue to go to lower levels. They usually start to revert back, and in order to revert back, that means the market has to start moving up. In theory, in general, and actually in practice. So, what do I mean by that? A few weeks ago, in part 1 of the 3% profit per month, we showed this view. Going from January to September, if we just traded high probability bear call spreads, even though the market was down from 480 to 400 at the beginning of September, SPY we're looking at here, you would have lost about 20%. Closing the positions when they reached within 1 or 2%, not doing any management, of course, but just doing this consistently, even though the market was basically in a downtrend. It was lower, never came back to 480. You still had about 20%. Of course, you can tell if you just traded bull puts, you were closer to an 83% loss from where you started off. I think it was about 82. If you started with $10,000, you're down to about $1,800. Again, just closing positions when they reached a trigger point. And then we showed that if you mixed them, if you did bear spreads during the first couple of months up until about March 15th, March 10th, and then you did bull spreads up until about March 29th, then you did bear spreads to about May 11th, and then you did bull spreads. You got hurt there a little bit on June 9th and June 10th. That's when we found out the inflation increased in May rather than decreased. And June 16th with a 0.75 rate hike. But then on August 15th, you started to do bear spreads again. You would have had a success rate around 84%. And that would have been around 3.8% return per month that we worked out during that presentation. But, and this was directly from that other webinar, I copied slides, but who wants to say it first? Great Captain Hindsight. Anyone can look at that past chart and tell you what they could have done. True. But those dates I just mentioned and selected were based on the signals in the Market Sentiment Tool. Early in December, late in December, my apologies, we started to see sell warnings pop up on the Market Sentiment Tool before that January decline. Next signal triggered, at around 315 and 313. So we're still, hey, we had some upward movements here, but we're still kind of going down and going down. And then we started to see those bullish buy indicators. It was right around here, 3.9, 3.11, 3.14, 3.15. And then we saw the bearish spreads. And what started to happen? 3.28, 3.29. Started to see the bearish sell warning. So we would have moved, maybe closed these out to the expiration or closed them early. And then now we're in a bearish spread mode. It was May 9th. Well, okay, May 6th, but May 9th, May 10th, and May 11th, really when it started to scream very bullish buy, right around in here. A little hiccup, but it was good. And then, yes, got clobbered here. Black swan event, unknown expectation. The market was wanting to recover, and then, whoops, no, we were wrong. Inflation was actually higher than we expected from the previous month. That killed the market. But what happened 5 days later? These were worse. Not worse, better. The very bullish buys were stronger. Now, at June 10th, 11th, and 12th, after that announcement came out on the 9th. And we were still in the bull spread area. August 15th, we started to hit the bearish sell warnings. Right about here, would have moved from bull to bear. These are also close to the inflection points, pretty much on the inflection points, where I was doing out of the money strangles starting at the beginning of the year in SPY. We haven't done a full presentation with direct insight into the selection and deltas. We've talked about it off and on a few times. But these were the inflection points where I would take the profits off of, well, I did it wrong first because I did it too short term. It should be 40 days out. But where I'd roll the strangle and take the profits and move it out to another time frame. And if I hit a profit I wanted, then I'd move it out again. Even though I was out to here, if I have the profit I want, I'd move it. And then rebracket it. Just kept rebracketing these strangle positions here each time the market sentiment was hit. So is it perfect? No, it's not perfect. This obliterated 40% of the gains that we had made so far following this pattern in that historical test. It's not what we actually did, but in that historical test where we still would have ended up profitable after this, it was because of sort of a black swan event, an unknown event that came out that spooked the market. And of course, what does that all mean for anything? What we're just trying to impress upon you is that this is how we've been using the market sentiment tool, and it has been working even in a market as bizarre, as frustrating for all of us. It's not just you guys, it's me too. That is 2022. Is it always picking the top or the bottom? Mike added later, now that I'm clicking through the charts on each of these indicators, I see why you're showing. So that's where the deduction is made. But I have a hard time believing that it's time to buy. That's like trying to pick the bottom, not a wise investment. We've had success with this indicator over many years. Bearish sell warnings started to appear in January and February 2020, and we adjusted, and we had several webinars on that as well. We've reviewed other historical times this worked. I'll share that with you in a moment. We are not saying put all your chips into long calls now that we're in a very bullish buy and risk be damned. That's not it at all. When we see a shift in the indicators, if we start to see bearish sells, we're going to lighten up on our holdings, maybe lighten up on the bullish strategies we might have that are leveraged, such as bull put credit spreads, bull call debit spreads, calendar call spreads. We might be adding extra protection if we're trading naked puts or covered calls, create some collars in that situation. We'll add a hedge to positions that might be exposed. If I'm currently in bear put debits, bear call credits, then I might be looking to add an extra hedge for those positions just in case this starts to snap, whether that's based on buying calls on SPY or QQQ or TQQQ, for example, or QLD in the bullish direction, so that if the market goes up and my bearish spreads start to get hurt, these calls on these ETFs are going to start helping to hedge some of those losses I might be taking. When I see the bearish buy sell signals, I'm definitely going to protect longer term. Add maybe extra protection even to married put positions I have that are already protected. Or if I start to see the very bullish buys, I might add to existing holdings or add to new holdings in anticipation of an upward move. Is it saying the upward move is going to be tomorrow? No. Is it saying it's going to be 5 days from now? No. Is it saying that it's going to be 10%, 15%, or 20%? No, it's not saying that either. What it's saying is that historically, when we hit these trends, when we start to hit the bottom of these various indicators, very rarely do those fences go below that. Back in 2008, looking 14, 15 years or more, they start to revert back. It's not giving you a time frame. It's not giving you a percentage on that as well. And that being said, I did roll the SPY strangles I mentioned earlier this week with the market sentiment indication. I was tempted to maybe roll them again today, but I wasn't at the profit percentage I wanted. Ernie and I both opened new married puts today for the Fusion portfolio, the Fusion subscribers at Radioactive Trading. Ernie entered Stride first, which is one of the 4 I was looking at. I was looking at Stride that came right up on the married put search. BJ's Wholesale was another one I was looking at. Lithium, I'm sorry, it's not called lithium, it's Linvent, but the symbol is LTHM, but it was really expensive put and a really high risk, even going several strikes in the money. So I went off the search a little bit and I went into NEM, Newmont Mining, stock that just started to break above, just broke above a positive MACD about 2 or 3 days ago. Ernie also mentioned that he's looking to buy calls now out to 2024 for TQQQ. That is not a direct recommendation or suggestion. I'm just trying to be fair and say that in addition, I understand your fears. Mike, I understand your concerns. Everything that's going on in the market, how can we even think that it's a very bullish buy? And again, because it's kind of contrarian. It's telling you that when these signals happen, they very infrequently continue to go down to go down lower. They usually tend to revert, and in order to revert, we're going to have to see the market, or we're going to expect to see, my apologies, the market moving back up in price. And that's what we expect to see. Okay. Robert does comment, the details you show on the webinar is different than the live look. Specifically, details are not shown. Well, let's just take a look. Part of the reason for that, here we go. Let's go back and I'll change that over. Oh, of course, now we also want to address Maurizio's question a little bit more directly while we're here. My apologies. All right. So on this webinar account, there we are, September 30th. We're back to 10 and 3. I think on the 29th, we were 9 and 4. Let's take a look historically. Yeah, so no, 3 and 10 and 3 and 10. My apologies there. 7, 6, 9 and 4 was the previous days on 9/27 and 9/26. Now, I don't have a lot of history here, but I wanted to go back to this point. So back in September, when we started to see the light buys and the bullish buys, is it really a strong indicator? No, but we did go from 39.55 up to 41, not a significant move. It went to neutral. When we started pulling back, it went back into a light buy range. And now here we are starting to see, we're dropping, but we're starting to see these. We fluctuated up a little bit. That's first, I'm sorry, folks, that first very bullish buy on 9/23, followed by some lighter ones. That did push back up. But then we've had the last 2 days, and it's triggering that very bullish buy again. Now, the reason why you might see subtle differences on this, and I do apologize for that, is that this one should be more akin to what you're seeing, Robert, on the live side. It might be subtly different, but this should be what you're basically seeing. Some of the screenshots I took for the presentation, Robert, these were based on the actual account, not the webinar account, Robert, the other account, my main account that I use that's real time. And we did several tests, and I just haven't corrected. What do I mean by tests? Way back when, 6, 7, 8 years ago, Ernie said to Greg, said to the programmers, why don't you let us, kind of play around with these to see if we can find better indicators. So sometimes when you see a screenshot that's subtly different from the live site, that's because it was from my probable actual account, where I made changes 6 or 7 years ago to try to run various tests with Ernie, and I never changed them back to the default. That's all. So I'm sorry if that confuses you, but that's what it was.